Earnings hell is coming, and it's going to crush stocks. I'm your host, Steven Van Metre, and thanks for joining me today. And while investors are looking for any kind of good news to kick off a big bear market rally, Goldman Sachs analysts are warning investors that earnings hell is coming, and it's going to crush stocks. Let's head over to Bloomberg when we pick up today's story, who headlines that U.S. profit margin estimates are too optimistic, Goldman strategists say, as S&P 500 margins to fall next year regardless of a recession, and strategists saying earnings risk are not fully priced into stocks. And while rotations within the equity market have signaled expectations of slowing growth, index valuation does not appear to be providing a buffer for the uncertainty around the path of future earnings. Profit margins for the median S&P 500 company will likely decline next year, whether or not the economy falls into recession. And while investors are focused on the possibility of recession, the equity market does not appear to be fully reflecting the downside risk to earnings. Goldman says the S&P 500 decline this year has been driven entirely by falling valuations, which in turn have moved in line with rising interest rates. And while rotations within the equity market have signaled expectations of slowing growth, index valuation does not appear to be providing a buffer for the uncertainty around the path of future earnings. And what Goldman is trying to say here, that if you think stock prices can't go any lower, that when earnings results kick in, likely they're headed much lower. And rising borrowing costs will also weigh on profitability through the energy sector, though the energy sector will be a tailwind for aggregate index margins. And for index investors, the largest constituents will also be key. The 10 largest S&P 500 companies account for 19% of aggregate earnings, and net margins for these companies are projected to rise by a median of 30 basis points in 2023. But their base case forecast, assuming no recession, shows aggregate S&P net profit margins remaining flat in 2023, while consensus estimates are much higher. And that is the key here, because what you're seeing is investors are looking for any sort of good news. And right now they're believing all these analysts are saying, look, don't worry about things being bad. Actually, earnings are going to get better and profits are going to get better and money keeps flooding in. And Goldman, who's really good at this, says, no, those are all wrong. Things are going to get worse, and that'll take stocks down with it. Let's continue on, because Goldman goes on to say the S&P 500 decline this year has been driven entirely by rising rates. The consensus forward PE multiple has compressed by 22% since the start of 2022, from 21 times to 16 times. And what does that actually mean? Well, it means that we're right now looking at an S&P that should be around 3,600. We know now it's above that, but if Goldman's estimates are right, we could actually see 14 times earnings, which would put the S&P 500 down to 3,150, and most investors are not prepared for that at all. And U.S. stocks are in a bear market, with the S&P 500 headed for its worst first half since Richard Nixon's presidency, as fears of potential global recession hammer risk appetite. But analysts have continued to be bullish about corporate earnings expectations, with net margin estimates for S&P 500 companies still at a record high. And here you can see forward margins are up here and the S&P 500 down here, indicating that we know which line is going to head lower, and that's the red one. But analysts still remain bullish. According to HSBC, in a note recently, equity markets are still underpricing the impact of a potential recession, while earnings and growth expectations are at risk of being revised lower, which would notably send interest rates down. And Morgan Stanley said on Monday that analysts need a reality check about their earnings projections for this quarter. Economists have begun to cut their top-down economic forecast for GDP, and yet fundamental company analysts are sitting there like a deer in headlights, not knowing what to do with the numbers. What they're suggesting here is that analysts are saying no recession is coming, there's no bad news, we don't care about the past economic data, we believe the coming data is going to be strong, and well, they're going to be wrong. According to Goldman Sachs here, you can see that relationship with Treasury yields that they mentioned, as forward PE is headed lower in this dark blue line, and that follows real or inflation-adjusted U.S. Treasury yields shown inverted. And of course, there is a cost to higher interest rates, and that's something that most investors just can't accept. They wanted higher interest rates. Well, now it's time to pay that cost. An elevated recession risk also means clear downside risk to profit margin and earnings estimates. Our economists estimate a roughly 50% probability of U.S. economic recession within the next 2 years. In aggregate, S&P 500 profit margins have declined from peak to trough by a median of 130 basis points in recession since 1970, ranging from an 80 basis point compression in 81 to a 180 basis point decline in 2001. Our analysis of equity market fundamentals and performance in past recessions show a 13% median decline for the S&P 500 earnings per share in recessions since World War II. And if you're concerned at all of what the probabilities of a recession could mean to your portfolio and how an earnings recession could send stock prices crashing, well, you shouldn't be. I'll put a link up here to Portfolio Shield and description below, a unique strategy that knows how to hedge big market drops. Because when we go back and look now at this profit margin contraction from Goldman, well, what you can see is the average is 132 basis points in contraction, something the market is not pricing in. And even outside of a recession, analysts usually prove too optimistic about profit margins, as post-recession recoveries are the exceptions when the consensus margin estimates need to be revised higher. And this pattern was repeated in 2021. This also roughly the magnitude of margin growth currently embedded in consensus estimates for 2023, but as they discuss, the outlook for profit margins today looks less favorable than usual. And here we can see that margins typically expand when prices and productivity outpace labor costs. And what I want you to think about is what's actually happening in the economy is as prices go higher, what do workers demand? Well, they demand higher wages. Now, unlike products where you can lower the prices or services where you can lower the prices, you can't just lower your wages of your employees. You can't go to them and say, hey, I know last week I gave you a raise. This week I need to cut it back a little bit because sales aren't there. But when prices are running strong and you're getting good productivity, and then but once wages start to kick up and all of a sudden sales slow, well, all of a sudden profits margins go down. And our macro model combines these relationships and points to declining operating profitability for the median S&P 500 stock in 2022 and 2023. In addition to revenue growth and the difference between core PCE and unit labor growth, the model includes PPI inflation in order to capture changes in input costs outside of labor. And here we can see the median S&P 500 company year-over-year margin growth excluding financials and energy. We see that Goldman's model here in blue actually seems to be very good compared to the consensus forecast. Of course, modeled forecast is set higher, but of course we know that's likely to be revised lower. And in contrast with consensus estimates, our model suggests that median stock will suffer margin compression next year, whether or not the economy falls into recession. And based on our economist forecast, our model points to a 70 basis point margin decline for the median S&P 500 company in our non-recessionary baseline and 130 basis point compression in a recession scenario. In contrast, analyst estimates show the median stock's margins expanding by roughly 60 basis points next year. But of course, we know that as demand slows and the Federal Reserve continues to tighten, things are going to go really bad for profits at a time the employers are pressured to pay higher wages, and we know demand's already slowing. But how can we tell in a very easy way that the Fed's a big player in this? Well, we've got this chart here of corporate profits after tax on a year-over-year rate of change against the monetary base, which is the Fed's balance sheet on a year-over-year rate of change. And in the past, the Fed's balance sheet didn't really matter much. But in this post-QE1, 2, and 3, post-Great Financial Crisis world, you see there's a lot of connection now where the monetary base often leads corporate profits up and then leads it lower. And what we're seeing now is a monetary base in contraction on a year-over-year rate of change, suggesting that corporate profits are headed much lower. And that's not the only factor here, as consumer confidence crashes in June. And what we can see is following the crash to record lows of the University of Michigan Sentiment Survey, which we've covered on a regular basis, the Conference Board's Consumer Confidence Index tumbled to a low in June. They were right, but it was considerably a bigger miss, with the headline falling to 98.7 from 103.2, well below the 100 expected. And this was largely driven by a collapse in expectations, which fell from 73.7 to 66.4. And you might wonder, well, why does that matter? Why does it have any effect on corporate profits? Well, it has a big effect, as you'll soon see. Here we can see the Conference Board's Consumer Confidence Survey heading lower in blue, with expectations absolutely outright crashing. But notably, their experts say that this is headed lower as confidence expectations are lagging the U.S. personal savings as a percentage of disposable income. But how does this tie back to corporate profits? Well, when we overlay the University of Michigan's Consumer Sentiment Survey, because the Fred database does not have the Conference Board's data, what we see is that consumer sentiment often leads profits as demand wanes. As consumers are less confident, they spend less money, and that brings profits ultimately much lower. But on top of that, we're going to see even more Fed tightening. If we just found out today that the Fed is just at the beginning of raising rates, according to Mester, there are risks of recession, she said. We're tightening monetary policy. My baseline forecast is for growth to be slower this year, but not in a recession. And consumers are experiencing this very, very high inflation, and that's clouding their confidence in the economy. We're in a path now to bring our interest rates up to more normal levels and even restrictive levels so we can get that inflation rate down and sustain a good economy going forward. Job one now is getting inflation under control. And Powell echoes that as he says today the U.S. economy is in strong shape and the Fed can avert a recession. And we hope that growth will remain positive, he said. But, of course, if it doesn't, and the overall U.S. economy is not going to hang on. But Powell says overall the U.S. economy is well positioned to withstand tighter monetary policy, telling us that, of course, from now, not only the Fed chief, but a voting member, that they're going to continue raising rates, shrinking the monetary base. It's going to have dire consequences for corporate profits, and that's going to keep sending stock prices lower, not, as most investors hope, higher. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.